Hello, everyone. Welcome to a Wall Street for Main Street podcast. My name is Mo Daoud, and today's guest is a returning guest, John Rubino, the editor of DollarCollapse.com. He also recently co-authored a book with gold money James Turk called The Money Bubble. Well, John, thank you for coming back.
Oh, hi, Mo. Thanks for having me on.
Well, the first question I wanted to talk about is the title of your book, actually, which is called The Money Bubble. Now, in the past couple of decades, we've seen bubbles in real hard assets like .com bubble, the housing bubble, but a lot of people out there are having trouble to understanding how can there be a bubble in money or currency.
Well, what has happened in the last few decades is that the world shifted from real money, which is based on gold and silver, to fiat currencies, which are basically make-believe and are based on our faith in the ability and the willingness of the governments running those currencies to manage them honestly and competently. And, of course, given that kind of power, they've abused it, and so they've just flooded the world with these currencies. And so we've seen a huge increase in the supply of fiat currency all around the world, and it really constitutes a bubble in fiat currency. It constitutes a huge increase in supply without a corresponding decrease in the value of each individual piece of these currencies. So that's really the same thing as a huge increase in price when supply stays the same. So what we've seen is all of these smaller financial bubbles like tech stocks and junk bonds and housing in the U.S. Inflate and then pop, but they've done so on the stage of the bigger bubble, which is fiat currencies. So when that one goes, everything changes. And so that's what our book is about, basically, how the world was able to blow up the mother of all financial bubbles and what things are likely to be like when the bubble pops, which I think it's going to imminently. We're not more than a few years away from the unraveling of the global financial system as we've created it.
Yeah, we're living in an era of a lot of uncertainty, and we don't know what's going to happen in the next few years because the way leadership is going in Washington, D.C. and other countries as well, the central planning economic, it's not working. They're short-term thinkers. They're just trying to get through the next election so they can, keep their seat in Congress. And so what we're seeing out there is a lot of bad policies, and one of them we're seeing right now is to increase minimum wage, which I think would do more harm than good. We can get into that later into this podcast. But I think we can agree the main culprit for this money bubble is the Federal Reserve and other central banks around the world.
Yeah, we basically handed the world's governments, via their central banks, the ability to create as much new money as they want to, which means that every time there's an election or every time there's any kind of military conflict, these governments are basically free to spend as much money as they want to achieve their goals. So it's taken away their need to prioritize. They're not dealing with a world of scarce resources anymore. They can have cradle-to-grave entitlement systems and global military empires at the same time, which in the case of the U.S. is exactly what we've done. And then just pay for it all with borrowed money and money that you've printed to cover the debts that you've accumulated. And in that way, push off today's problems into the future and leave them for your successors to deal with. Well, we're living in the long run of the people who made these bad decisions in the past. And we build up debts that are just unmanageable wherever you look, whether it's Japan or Europe or certainly the U.S. and now China, it's coming to light that they're deeply, deeply in debt. We've borrowed more money than we can ever hope to pay off, and so we're left with just a few really painful choices. And so what's happening in this decade is us coming to grips with the fact that we only have painful choices now. We only have choices of different kinds of catastrophe, and us kind of deciding which way we're going to go, which kind of pain we're going to choose. And it looks like we're all in the developed world and most of the developing world gravitating towards the inflationary choice. In other words, we're going to try to get out from under our debts by creating so much new currency that the value of each individual piece of currency goes down and our debts become less onerous. And in that way, we're hoping to be able to grow our way out of our debt so that 10 years from now, maybe we owed the same amount of money, but our economies are 3 times as big in inflation-adjusted terms, and we're able to cover our debts. Well, that's not going to happen. That's a recipe for disaster based on history, because so many countries have tried this in the past where they devalue their currency really aggressively, hoping to get out from under their debts, and all they buy is chaos. It destroys the function of money as a measuring stick and a store of value. When money doesn't function anymore, a society devolves into chaos. And so we're making the choices that, if we continue along this road, will lead us to chaos, as in Weimar Germany or France a couple of times in the 17 and 1800s, and many, many other countries going all the way back to the Roman Empire, who have all made these same mistakes and ended up in basically the same place, which is financial crisis followed by a disastrous collapse, followed by a reorganization of the government and a return to sound money. So that's our next 10 years.
And you made a good point there, talking about the past, because the currency war and the money bubble, it happened before in the past. I don't know, a lot of people don't realize that. Going back to, as you mentioned, ancient Rome, when they tried to increase their money supply by substituting gold and silver and using copper because it was more plentiful, and that results in an increase in money supply, and then they had inflation, and that started the collapse of the Roman Empire. So we see that happen, and then we go to the French Revolution twice. They did it twice, and it failed. And then we see the Great Depression and other major economic events that happened in the past, and yet the politicians are still committing the same mistake as in the past. Why is that?
Oh, because they're taking the easy road in the short run. In other words, creating lots of money right now and buying your way through the next election is the relatively painless alternative for a politician whose only other choice, once you've taken on too much debt, is to allow the system to collapse into a 1930-style depression. So they do this over and over again because in the moment, it always seems like the smartest, easiest thing to do for their careers. In other words, they get to stay in their job for another election cycle if they inflate, whereas they wouldn't, they'd get kicked out of office if they didn't inflate. So if you give them the power to inflate, in other words, the power to create money out of thin air, governments will always choose that, and they'll always abuse that privilege because in the moment, in every moment, there's always an upcoming election, there's always some constituency that is clamoring for something from you. And to buy them off is to survive for another election cycle. To stiff them is to be kicked out of office. So politicians will always, given the ability to do so, choose to inflate. So the only solution, obviously, is to take the printing press away from governments and have money be something that exists separate from the political process. We did that for a long time with the classical gold standard, and then the dollar-based standards that succeeded the classical gold standard up until 1971. We always had some kind of a restraint on the ability of governments to just create money out of thin air. And then in 1971, the U.S., having borrowed too much money to fund the Great Society programs and the Vietnam War at the same time, found itself losing all its gold because it was obligated to exchange gold for dollars. And everybody was presenting their dollars to the U.S. and wanting gold in return. So we were either going to lose all our gold or stop that. Stop the exchange of gold for dollars. And so we did. We broke the link between the dollar and gold, and thereafter the dollar was just a piece of paper that depended on our trust in the government. And ever since, the government has been free. So, knowing what you know about human nature, you would expect in that kind of a situation to evolve into a system that is deeply indebted, that has taken on way more obligations than it can ever hope to satisfy, and that is actively trying to inflate its way out of that debt. And that's exactly what we got, Somebody from the Austrian School of Economics could have looked at our situation in 1971 and said, okay, within a few decades, we'll be here. They could have easily predicted our current state of affairs. And that's because they understand how money works and how credit works and how human nature interacts with those things. and most other schools of economics don't. But those guys got it. Their predictions were correct, and here we are. And it's interesting that the next stage of this process, from an Austrian economics point of view, is something called the crack-up boom, which is the final stage in the process when people finally realize that it's the official ongoing policy of their government to depreciate their currency over time. In other words, to make the money in your pocket and in your bank account less valuable year after year after year, forever. And so people rationally, once they figure this out, all head for the exits at once. They start converting their currency into real stuff as soon as they get any money, and at any price that they have to pay. So the price of everything goes through the roof, which is really the same thing as saying the value of the currency goes through the floor. And you get a system that kind of manifests as hyperinflation. It feels like prices are just out of control. And really what's happening is everybody has given up on the currency. And so we're heading in that direction, and we will get there in the not too distant future. The only question now is, how do we get there? You know, what blows up first, and who makes the really horrendous decisions that push us off the cliff? And that could happen in the developing world right now, where a lot of emerging markets are imploding, or it could be Japan, you know, as you and I talked about before we went on the air. Their debt situation is absolutely unmanageable, and it's only a question of when it blows up. And Europe has a different set of problems, but they're equally severe. And they could be the catalyst for the global crack-up boom, you know, or it could be the U.S. We're an incredibly badly run system, and a lot could go wrong here. So we don't know who's going to start it or exactly how it's going to progress, but we know what the end point is, and that is when most of the world gives up on not just individual fiat currencies, but the whole concept of fiat currency. When we finally figure out that a printing press in the hands of a government is a recipe for disaster, and we give up on the currencies that are being run by governments because we see that not just the governments themselves are doing a bad job, but the whole idea is fatally flawed. And at that point, you know, you got to figure out what you want to own. If all of the currencies that are right now functioning as money out in the world don't work anymore, then you've got a really interesting money management challenge to structure your capital and your assets in such a way that you not only protect yourself from this process, but you know, gain a lot of value along the way. So that's really the challenge that faces today's money managers and today's individuals who are trying to manage their family finances. How do you navigate through something like this when you kind of sort of know what's coming? You don't know the details, but you know the broad outlines of it. But you know it's not just affecting a given asset class like junk bonds or tech stocks. It's affecting your money. You know, the environment, your financial environment is going to change in a really fundamental way. And what do you do?
And that's a great point. And the only reason why this U.S. economy hasn't gotten to the crack-up boom yet is because the government has done a good job hiding the numbers, hiding the inflation, and also the corporation find ways to cut down a portion of their products without increasing the price, and then a lot of customers don't even realize they're getting less of a product and still paying for the same price, which is, you know, still inflation.
Oh yeah,
so,
yeah. We have a lot of hidden inflation going on right now because you know, the official government numbers show very modest inflation, which is to say a very well-managed monetary system, but that's deceptive for a few ways that you mentioned. You know, one is that they're lying to us. They're rejiggering the numbers in such a way that, according to John Williams at shadowstats.com, who's a guy who calculates inflation and other major government statistics according to the old way, back before they started manipulating them, and he says that the gap is about 7%. So we've got about 10% inflation going on right now, just using the methodology from, say, 1980 and applying that to today's world. Another way that they're lying to us is that, as you said, companies are charging the same amount for their products, but giving us less. You know, making the box the same size, but fewer cornflakes or cookies or nuts or whatever in the box. And so in that way, we think we're getting the same deal, but we're not. And people are gradually starting to figure that out. And the final way, and I think it's the most pernicious way that inflation is being hidden from us, is that we've defined inflation differently than originally. Inflation used to be an increase in the money supply, which could have all kinds of different effects out in the global economy. We eventually changed that definition to increase in prices at the consumer level, which isn't really inflation. What we've got right now is an increase in the money supply, which is manifesting as asset bubbles. So in other words, we're creating lots of new currency, but instead of flowing to every single product that's for sale out there and bidding it up by just 10%, let's say, it's mostly flowing into the hottest asset classes at any given time. So, first it flew into junk bonds in the 1980s, and then into tech stocks in the 90s, and then into U.S. housing in the 2000s. And just lately, it has flowed into the emerging markets of the world. It's allowed China to build just an insane number of skyscrapers and factories and roads all over the place, and it's bid up asset prices in Brazil and Thailand and India, and created asset bubbles in all of these different places, which we in the U.S. don't necessarily see. It's not part of our lives, so we don't feel like things are spinning out of control. But if you were in India or Brazil or Thailand, you'd feel very differently, because you would see the price of houses going through the roof and then crashing, and the price of energy bouncing around, and your currency plunging and then spiking. And all this kind of instability is coming from all the hot money that is flowing out of developed world central banks and into the emerging markets. Now, that bubble looks like it's about to burst. In the last few months, we've seen a lot of emerging markets get into trouble, see their currencies plunge, see their stock markets plunge, and then have to impose capital controls or raise interest rates. Brazil's overnight lending rate is 10.5% right now. Turkey's is 12.5%. So we're seeing financial instability in the developing world that is reminiscent of the 1970s for the U.S. Really crazy times. And that's a form of inflation. But we just don't see it because the money is flowing globally into these foreign assets. So let all of that money start flowing back into the U.S. There's about $15 trillion outside the borders of the United States, which don't count in our money supply statistics, but could easily be converted back into U.S. assets. If people decide they don't want to be in emerging markets anymore because they're too worried about Chinese debt or Thai political instability or whatever, and they decide they want to buy U.S. assets with those dollars, well, that would, in effect, be like hot money flowing into a developing country, only it would be $15 trillion flowing into the U.S., and it would spike our asset prices and cause political and economic instability here, the same way that a year ago it caused that kind of stuff in Thailand and Brazil. So we could see raging inflation, no matter how you measure it, in the next couple of years when those dollars come back home. And, that's one more way it could go. I have no idea, which one of these scenarios is going to play out, but that's a very possible one, that people in foreign countries decide they don't need as many dollars as they thought they did, and try to convert those dollars into U.S. stocks or U.S. real estates or treasury bonds or something like that, and then destabilize us.
And that's a trend we're seeing right now around the world, that countries like China and Japan are buying less U.S. treasuries, and they're buying other hard assets such as gold and silver, India as well. And in result, the Federal Reserve have to buy up those treasury bonds. And also, the Chinese are also selling out of their treasury bonds, which is now coming back into the United States. And now the president's now talking about a new form of IRA that he's about to roll out called My RA or My RA, which is something where any American can invest in treasury bonds. But if you look at it at a different angle, I think it's one step closer to having the U.S. government mandatory have every U.S. citizen buy treasury bond in their portfolio, so that the ease the inflation that they're trying to control, which is not going to, it'll be impossible to control in the long run. And also, it will ease the Federal Reserve balance sheet, which is exploding to over $4 trillion.
Yeah, you covered a lot of interesting ground there, Mo. One thing that you said that I think we should emphasize is that China is doing something interesting right now, because they're just buying up all the gold that's available out there in the world. And at the same time, they're dumping U.S. treasuries, which means in effect, they're converting their dollars, of which they have several trillion, into gold. at basically the fastest rate that it's possible to buy gold out there. And so the longer that goes on, the better it is for China. And it's not clear how long they can keep doing that before they spook the markets and cause a spike in U.S. interest rates, which would derail the whole process, derail everybody's process of any kind. And the other thing that you mentioned that's really interesting is, the U.S. is introducing maybe another kind of savings account that would be a mandatory savings account. And this is, I think, part of the process of wealth confiscation, which we're seeing variations of all over the world. The bank bail-ins that began in Europe are basically governments coming in or banks coming in and just taking money out of people's bank accounts. And we've seen more direct forms of asset confiscations in other countries. Poland and Argentina, I think, are two who just took pension plan assets and used them to run the government. And the idea of bank bail-ins now is becoming mainstream policy. So the next time a big bank gets in trouble, if it's your bank, you're liable to see them take a chunk out of your bank account. There's a small step from there to the government looting our 401ks and IRAs, because that's this huge multi-trillion-dollar pot of untaxed capital right now that governments have got to be desperate to get their hands on. And at some point they're probably going to make that kind of move. They're going to figure out a way to either force us to convert a lot of our assets into treasury bonds, which would in effect be forcing us to finance the operations of the government, or just go in and do a 10% across the board wealth tax or something like that, where they just take a piece of everybody's pie. And something like that is coming. We don't know what kind of form it's going to take. We see a lot of examples out there of forms it could take. We don't know specifically how it's going to work in the U.S., but some form of asset confiscation is probably coming our way. And again, it comes back to how are you going to manage your money with all of these cross currents and all these really dire predictions out there and these crazy scenarios, because it's not clear how you protect all of your assets in those circumstances. I think there's now more of a rationale for diversification than there ever has been, but I think you should extend it to geographic. You should move some money offshore if you can, and have physical assets in hand that aren't registered with anybody, and a minimal amount in assets that require the dollar to hold its value over time. You don't want to own bonds anymore, or bank accounts in general, just because they're not as safe as they used to be. These used to be your risk-free assets, and now because you have currency risk thrown into the mix, they're not risk-free anymore, because they're paying you in a currency that the government is actively trying to devalue. And that's the same thing as saying they're actively trying to steal your savings. So knowing that, you've got to think about what you want to do. And precious metals plays a big part in this, of course, because gold and silver are forms of money that governments can't just create out of thin air. And so those are things that governments can't make less valuable through their own actions. They hold their value over time. They don't require anybody else to keep a promise in order for them to hold their value. And because of that, it's possible that precious metals will be the big winners in all of this, along with a few other hard assets like energy, well-chosen energy assets and well-chosen farmland, stuff like that. But precious metals is the portable choice among the hard assets that should do well in the crazy times that definitely seem to be coming.
And I agree with you there. People should definitely have a portion of their portfolio in precious metals as insurance against the currency war that's currently going on in the U.S. and also in other countries as well, such as Japan, China, Brazil, and other developed countries. And also, you talked about how having your assets diversified in different countries as well. If you're able to, that's also something that we also suggested to people as well. So, before we let you go, I have one final question, and this is regarding the increasing demand for higher wages. Now, President Obama today is demanding to raise minimum wage to $10.10. And now, do you think this is a direct result of reckless money printing from the Federal Reserve and other central banks? Because it's not just happening in the U.S., it's happening in other countries as well. demanding for higher wages.
Oh, yeah.
In South Africa too.
Well, inflation is guaranteed to lead to this kind of thing because it basically enriches the wealthiest 5% or 1% or whatever of a society, because those are people who own the assets that go up in value during an inflationary time. You know, the richest people in the country own most of the equities, most of the farmland, most of the energy-related assets in the world, and those things are getting more and more valuable. So inflation, as we're generating it, tends to increase the gap between rich and poor, and it tends to make the 95% of people who are being impoverished by it less and less sanguine about the system. They no longer trust the people in charge. They now see capitalism as a license to steal, and so they're less and less likely to vote for policies that perpetuate the system. And so basically what they're trying to do is protect themselves by demanding higher wages from the guys who they see being enriched by the current system. And they're trying to, if they're in the middle class, they're trying to hold on to that. If they're on the lower rungs of society, they're trying not to starve, you know. These guys out here who are demanding a higher minimum wage are just trying to support their families or support themselves, and they're having a great deal of trouble doing it while working at Walmart or McDonald's or, you know, one of the other crappy jobs that are left after big companies have shifted all the good jobs to China. And so it's a completely understandable response, but it leads to even more instability, because when you have a divided society like this, where we disagree fundamentally on the basic premises of our society, you know, how things should be structured and who should keep what from the fruits of their labor, then you have a system that can't get anything done substantively. And what's going to happen now is we're just going to have chaotic election after chaotic election when nothing is really fixed and our current policies just operate on autopilot until it falls apart. And then at the bottom, from the rubble, we will be able to have a discussion about what kind of a society we want to structure going forward and maybe rebuild something that works. But until that time, there's nothing that's going to get done. You know, the richest 1% don't see any reason to change. The rest of us don't see any reason to keep the current system in its current form. And so you've got basically extreme political instability leading to and feeding off of economic instability for as far as the eye can see until the system breaks down. And that's not just the U.S. we're talking about. Most of the rest of the world is going through something similar to this. Europe is seeing political parties that used to be considered, you know, fringe crazies go mainstream and start to, if not lead in public opinion polls, then at least seriously challenge. And a lot of those parties are anti-Euro. Let a few of them get elected and start dismantling the Eurozone, and you'll see more chaos in Europe than we've seen since World War II. And, you know, go to any developed country or developing country right now, and you see huge dissatisfaction, although that's less their fault than it is the developed world's fault, because we dumped all that hot money on them and now we're pulling it back out. And they didn't really have any control over the process, but they want to blame somebody, so their elected leaders are going to be the ones who get blamed for it. So anyhow, long answer to what was basically a short question. The movement for a higher minimum wage is a completely to be expected phenomenon, and it won't lead to the kinds of things that anybody expect, because it's really just a sign of growing instability, and it's not part of structuring a just society yet. We have to wait until this system breaks down before we have a chance to do that.
And I agree with you, and I've done my homework on minimum wage and how it could affect the economy, and it will do more harm than good. The CBO put out a report that if they raise minimum wage to $10.10, that over 900 jobs will be lost. And then you hear Obama come out today and say, if we raise minimum wage to $10.10, 900,000 people will come out of poverty. So it's pretty much a wash. You won't get anything from the...
These things get very mixed results, and the people on either side tend to focus just on the the result that suits kind of an ideological perspective, and so it's actually much more complicated than you would hear on the news. And so, but in the end, again, I don't think it matters that much to where we're headed, because it's more of a symptom of a disease than it is either a cure or a disease in its own right. You know, it's just something that happens when things start spinning out of control, and it's a sign that crazier times are coming. So I think that, 10 years from now or whatever, when we're debating all of this and trying to decide what kind of a society we want to create out of the rubble of this one, maybe we can have a really rational discussion about labor laws and protections for workers versus freedom for capital to innovate, and it'll be interesting. And right now we just have so much baggage and so much junk coming up the system that nothing that we do is going to either fix things or cause things to get much worse than they were going to get anyhow. So I don't know. I'm past the point where I think there's any kind of a fix or where there's any kind of real new damage that can be done. I think we're on autopilot, and the policies in place are heading us off a cliff right now. And so that process of going off the cliff is what's both fascinating, in kind of a car wreck sort of way, and also crucial for us to understand when we're trying to structure our own lives, because this is going to happen, and we need to be prepared for it. And we don't want to get bogged down in the political issues of the day, because we've got so much going on right now, healthcare and immigration and gay marriage and stuff like that, and all of them, in their own way, in their little box, are very valid issues to debate. But they can distract you from the bigger issue, which you really need to pay attention to, which is that we're building a financial crisis of just epic proportions, like nothing that we've ever seen before, and we need to be ready for it.
Well, John, I appreciate you coming on for Wall Street from Main Street podcast. So if people want to find out more about your work and your book, The Money Bubble, where can they buy it? Tell our audience where.
Sure. I run dollarcollapse.com, which is a site that covers a lot of the stuff we talked about on a continuously updated basis. And you can go there to buy the book, or you can go directly to Amazon and buy it. It's The Money Bubble by James Turk and John Rubino. Or you can go to any bookstore and they can order it for you. And then it'll be delivered in a couple of days.
Okay, great. John, thank you for coming on. Hopefully you can come back on soon again.
Great. I'd like that, Mo. Thanks.